Thank you, and welcome to our presentation on the facts behind the figures. I am Doreen Awanga, the company secretary, and with me we have Ajay next to me, and on my far left we have Frederick Akoza. This is a team that will be taking you through our recently published audited accounts for the year 2021-2022. I'll hand over to our CEO to take over the presentation.
Thank you, Doreen, and welcome to each one of you. And thank you for joining this call, as well as I wish that you and your families are remaining safe. Go to the next slide, please. It's just a disclaimer talking about the information what we're going to share. I'm going to go to the next slide. And we'd like to welcome you with this video. As we say that other than just saving lives and taking care of people's health, we also create a lot of awareness on the different therapy areas and some of the biggest endemics in Africa. It's just a video we launched on the World Malaria Day, providing information on malaria and how we can prevent it. Thank you. And it was more relevant because a big portion of our business is focused on delivering treatments and saving lives from malaria in the African continent. Coming back to our last year's numbers, reflected on the screen, our revenue declined with respect to last year by 6%. But when we take a base business and remove the exceptions what we had in the last year, it grew by 3%. We continue to see momentum in our local Uganda sales, as well as we continue to see momentum in institutional buyer sales as well. What we have seen declining is sales with respect to other government and the opportunities which we received in the last year due to COVID. I would also want to highlight this drop is on the backdrop of last year's significant growth in terms of revenue of 48%. In terms of profit, we have done incredibly well, and it was one of the focus area for management in last year to bring the business to profit. Our EBITDA margin with respect to last year grew by 18%, and if we remove exceptions, it grew by 16%. And same reflects in our net profit margin as well, which grew by 13%. And if we remove any exceptions, it grew by 12% as a base business. Bringing to some of the highlights, what we have seen in the last year, as I have alluded to that, our focus last year was primarily to turn around the profitability. As most of you are aware that we were making loss from a couple of years, but this year is the first year where we have turned around and we made a significant profit. At an EBITDA level, we reflected $13.7 million as profit versus last year negative $2.2 million. Other than EBITDA, we worked a lot on our people practices, and we won in Prudential Best HR Award in reward and recognition category. We were also second runner-up in the financial reporting for the last year's cycle. We in the full year shared that how we are shaping our portfolio strategies, and we have introduced 3 new products locally manufactured in Uganda: azithromycin 500 mg, Cipladon Plus, and Q-tip. We had made long progress again in last year to recover a long outstanding Zambia debt. And we're happy to report that out of the total outstanding, $5.3 million, which is close to 50%, has been paid by government of Zambia in last year. And we are hoping, given the engagement we had with government of Zambia, as well as the progress we made, that the balance amount will be collected also pretty soon. Apart from the financial metrics, we have also aggressively worked to improve our certifications. And we're happy to report that in last year, the CiplaQCIL business is certified ISO 19001, 14001, and 45001. Our long-term growth is being underpinned with our MOU, which we have signed with government of Uganda to manufacture and supply anti-cancer, sickle cell anemia and tuberculosis products. And we were also happy to report that we have settled payments of overdue, which were long pending with the business. Go next page. I will now invite our CFO, Fred Kakuza, to take us through details on financials.
Good afternoon, investors. Thank you very much, Ajay. I would like to start from where we knocked off last time at H1 and present how our second half of the year has been. I'm comparing our performance of second year to that we had in the previous year, that is financial year 2021. Our revenue closed in at 143 billion compared to 161 billion in the previous year, which was a decline of about 9%. But when you look at our EBITDA level, EBITDA is earnings before interest, tax, depreciation, and amortization. We closed at a healthy 37 billion compared to 17 billion last year. So the traction that we started last year has now even moved more in terms of profitability, as the CEO mentioned. Our EBITDA as a fraction of revenue was 26% compared to 11% in the previous year, registering an improvement in that margin by about 15%. In the second half, our profit after tax was about 21 billion compared to 6 billion in the previous year, which is about 250%. In terms of margins, our net profit margin or part as a percentage of revenue was 15% compared to 4% in the previous year, registering an increase of 11%. Ladies and gentlemen, I'd like to draw your attention to some cores of our business. We have both local sales and we also export part of our products to other countries to treat patients in those countries. So out of the 143 billion that we sold in the second half of the year, 110 was sold to customers in Uganda, and the balance 33 was exported to patients out of Uganda in Africa. Next slide. I would like now to show a picture of the full year position. Our full year revenue for the year financial year 2022 was 267 billion compared to 285 billion in the previous year, recording a 6% reduction. As mentioned earlier, this was mainly because the COVID opportunities that came up in the previous year did not recur this year. So when you look at our base revenue, we actually registered an increase of 3% if you exclude the exceptions as previously presented. Our EBITDA closed at 48 billion compared to 1 billion, registering an increase of over 100% when you compare the two periods. Our EBITDA as a fraction of revenue was 18% compared to almost zero in the previous year, registering a leap of about 18%. This year, our profit after tax was 24 billion compared to a loss of 11 billion in the previous year, still registering a profit of over 100%. When you look at the net profit margin, or what we call part as a percentage of revenue, it is 9% compared to a loss position of 4% in the previous year. I would like to break down the revenue between exports and what we consume locally. And the 267, out of the 267 billion that we sold in the previous year, 187 was sold on the local market, and 80 billion was exported to other countries in Africa. Ladies and gentlemen, I would like to take you through our financial ratios. These financial ratios indicate a healthy improvement in they indicate a heavy improvement in the performance of the company. Our profitability, liquidity, and gearing ratio are all improved. Maybe starting with the profitability, our gross profit margin jumped from 19% to 26%. Our EBITDA margin closing at 18% compared to almost neutral in the previous year. And our net profit margin closed at 9% compared to a loss of 4% in the previous year. The other ratios are also positive as indicated on your screens. I want to move over to the liquidity. Our current ratio continues to be above 2, improving from 2.1 in the previous year to 2.4 in the current year. And our quick ratio is also above 1 for both years, improving from 1.1 in the previous year to 1.3 in the current year. Working capital has increased significantly from 78 billion in the previous year to 103.5 billion in the current year. The main reason for the improvement in working capital is profitability from operations and also part of the payment from the Zambia government. Our net cash position has also improved from the 7.6 billion we closed at last year to about 8.5 billion this year. Gearing, which is a percentage of debt to equity, has also improved. The main reason for this was payment of the debt in line with the covenants, and then also not requiring additional debt for the operations because we're in a positive cash position. About the cash cycle, we're at 169 days compared to 142 days. And the main reason for that is the increase in inventory days, where we're keeping the stock to keep the factory running and also to cope with the challenges in the geopolitical environment of these days. Thank you very much. I would like to hand over to Ajay.
Thank you, Fred. So as we shared that there were two main focuses the management had in the previous year. One was to bring the business to profit. And I think the second one was to expand the portfolio. And that portfolio expansion actually becomes the basis for the future growth. Most of you know historically, CiplaQCIL primarily focuses on 3 therapeutic areas and produces products in those therapeutic areas: HIV, malaria, and hepatitis B. But we're also happy to share that we expanded that portfolio and therapy areas to add 2 new therapy areas. One is macrolide antibiotics and pain management. And we've introduced 2 products, azithromycin 500 milligram and Cipladon Plus. And both of these products are locally produced and manufactured here in the facility in Luzera. I would also like to draw attention to the revenue trend in last 4 years, specifically post-listing, and then how the business is performing, and then a breakdown on therapy areas, specifically drawing attention to how the new product range started to shape the therapy and started to expand the pie chart what we see. So if you see the revenue trend from 2018-19, it is the listing year when the company was listed, it was 195 billion Uganda shilling. And it has grown to 267 billion if you take FY 21-22, which talks an 11% average increase in the 4 years. 2020-21 was an exceptional year with 48% jump, and it has a big component of once-off COVID opportunities, which was received at the onset of COVID, where the borders of the countries were closed and they were not able to get supplies from the routine suppliers, and CiplaQCIL plays a pivotal role at the time. If you see the therapeutic area, which is in the right, and you see a very small gray pie, which is moving from 4 billion to 9 billion, this is where the new products started to contribute, and This is the private market and therapy area which newly introduced in the business. Can we go next? We've also created a growth engine, and we are focusing on 4 main areas. And this is not just for 1 year, but it's for long term, how this growth engines will keep on performing. And the first area is growth and sustainability. And it's primarily focuses on 5 main areas. Customer base penetration, it means the existing customers with the existing portfolio, how we repeat and regenerate and generate more sales with them. The second area is product expansion, which primarily talks about all new segment, which is private market, and it has new therapy lines and new products into it. The third one is market acceleration, which talks about increasing exports. I know we have declined in export sales versus last year, but it is primarily because there were some COVID opportunities which we received in the previous year. But now we are building a base to expand and export more products to rest of Africa outside Uganda, and we want to accelerate that space. I think the fourth one is to make sure compliance. As many of you know, we are of the few pharmaceuticals company in the region which are WHO pre-qualified. And I think that qualification and the world standard is always hold up to the top, and it's always remain a focus for the management that we may remain compliant to the global regulatory standards. And the fifth one is our renewed commitment to governance, community upliftment, access to affordable healthcare, and environmental conservation. I think the second base area where we have done a lot of work in the previous year is cost leadership, and you see the impact of those in our results as well. But we will continue to work on it. I think it's a continuous improvement area, and we will continue to improve in operation costs, continue to make sure that our margins has been always improved. And we'll adopt digital tools to process and simplifications, which again adds to cost leadership. Third area is business development, which is makes what we can sell in future, and it focuses on access to products, technology, and market presence. And I think the fourth area is a balance of profitability and the investment for future. We already made one decision that we are investing in anti-cancer, sickle cell and TB production facility, which is the future growth driver for the company. Next slide, please. Now, those are regular growth engine, which continues year and year after. But let's also focus and share some details on what are our key priority for FY23, the year which we have started now. So we will focus on private market, and we will focus on building strong sales structures and accelerate our growth in the private market sector, especially in the domestic market. The new facility for future growth, anti-cancer manufacturing plant, will make sure that construction begins pretty soon, because we have done the detailed engineering work, we have completed it, we have received almost all regulatory approvals from the local authorities, and we're going to very soon start the groundbreaking to start construction. Reimagining the portfolio, I think it's becoming pivotal for the company to expand beyond what they were doing and go into therapy areas, which is not just HIV, malaria, and hepatitis, and also go into some lifestyle disease therapy areas as well. And in that quest, we'll produce 9 new products in this year, and also expand the therapy areas beyond the 2 which is already introduced. We will focus on data-rich tech platform, and specifically in the area of supply chain, manufacturing, and finance. And this is, again, going back into the cost leadership element, what we were talking about. And they will underpin the cost leadership in the longer run as well. Financials, we will target sustainable and profitable growth. Given the fundamentals, what we have put in place, we are hopeful that we'll continue to grow and continue to grow profitably. We will focus on improving overall return on ratios. You see our ratios significantly improving with respect to the previous year, but we're going to take it from here to the next level. Sustainability, it's in focus across the world, and we as a company will also not be shying away to take a target on sustainability. We'll have a strong focus, build on legacy rooted in caring for life. We always believed in caring for life and serving the people. and the communities and the planet. And the last is, we strongly believe that this all could not be achieved without the staff and the people who work for us. We will keep on focusing on retaining our talent and attracting best-in-class talent to support our growth strategies. Thank you very much. I think we have a Q&A now. So we present our short summary on what happened in the last year. Our detailed results are already there in our website, so you can go and have a look on the results as well. And I hope you have looked into it.